So if you think about it, go back to the pandemic. Go back to 2020. Go back to pumping gas into your truck at $1.85 a gallon, knowing what you knew today. If you were able to lock in those rates or lock in those prices at $1.85 a gallon instead of paying $4 plus today a gallon, wouldn't you do that? Well, you have the ability to do that. You have the ability, the tools and resources to do that through things called Roth conversions. The idea is you want to lock in your tax rate for your lifetime plus 10 years or more. What do I mean by your lifetime plus 10 years or more? Again, this came from my friend and mentor, Ed Slott. Ed was talking at one of the events and he said, under the current tax codes, you can lock in your tax rate for your lifetime or 10 years. So what is he talking about? We know that if I do a Roth conversion today, so Roth conversion is simply, here's your tax deferred bucket, tax deferred, and here's your tax advantage bucket, tax advantage, and we're talking about Roth IRAs. You can, via conversion, move money from your tax deferred bucket to your tax advantage bucket. They're the tools the IRS gives us. It's really that simple. There are two ways to get money to Roth. One is contribution, and two is conversion. So we've talked about Roth contributions before. We've certainly talked about Roth conversions before, but Roth contributions have some limitations and requirements, and I'm not going to go into that right now. Today I'm talking about conversions. There are no guardrails. There are no speed limits on conversions. If you have $1 million over here in your tax deferred bucket and you want to convert it all in 1 year and take that $1 million and plop it over here, you can do that if you want to. You're going to what? You're going to pay tax along the way. So if you assume a 35% tax on that, or 30, let's bring it down to a 30% effective tax rate, you're going to pay $300,000 in tax on that. That's probably not what you want to do. What you can do is you can schedule a ladder or a schedule of conversions over the next several years. We probably have at least six to 8 years, maybe on the outside 10 years, but 6 to 8 years to get this job done. Tax years, including 2024. So instead of transferring $1 million all at once and paying a higher than necessary tax rate, what if you came up with a schedule or a ladder or whatever you want to call it, and instead you transfer it over a period of time, over 5 years, 4 years, 6 years, 8 years, whatever works for you, and you choose your tax rate because you get to choose. You say, in this year, I'm going to push up. I'll just draw it again. I'm going to push up, for example, into 10, 12, 22, 24, 32, 35, and 37. I'm going to push up to the top of the 22% bracket. And we know that today, I hope you can see what I was just doing. We know that today, the top of the 24% bracket is $383,900. I'm sorry, we're going to push up to the top of the 24% bracket. And that's $383,900. So you could say, okay, I'm pushing to the top of that. And maybe for you, it's the top of the 22% bracket, and that's okay. And let's go back. That is $201,050. So $201,050. So either one that you choose or either one that works for you is your choice. So you can choose, okay, I'm going to pay my taxes at 22%, or I'm going to pay my taxes at 24%, and you're never going to pay tax on that money again. Because once it transfers over to this bucket, to the Roth bucket, and let's just say it's not $1 million. Let's say it's $250,000 that you transfer over, or maybe it's $150,000 if you're trying to stay below the 22% bracket or within the 22% bracket. But you pay tax on that along the way, and you can pay it. If you're over 59.5, you can pay it via withholding. If you're under 59.5, you'd have to pay it out of your savings, other savings or investments or earnings, and that would come from the taxable bucket. But once the money's over here, it's never taxed again. So you, in fact, have chosen your tax rate in your retirement. You've said, this is me. I'm at 22%. I've chosen 22% for my tax rate in retirement, or I'm at 24%. That's my choice. That's my tax rate in retirement. Some people with more money in their IRAs, some people have much more than $1 million in their IRAs. Sometimes it's 3, 5 plus millions of dollars in their IRAs. Sometimes they go up into higher tax brackets, 32, 35, 37 is rare, but sometimes we see it. But isn't even 37 better than 40, even if it just goes up to 40? Yeah, 3% is better. 3% is cheaper. 37 is less than 40. But if you've got $3 to $5 million, you're probably going to be in a much higher tax bracket, maybe 50 to 55. Listen, these recommendations that we're seeing are not cheapest at all. We're looking at significant increases. So you can certainly choose your tax rate in retirement, and you do it simply. The first step, figuring out your Roth conversion. So there are other things you could take advantage of. Cash value life insurance, if you're funding money, especially from your taxable bucket. But today we're talking about choosing that tax rate using Roth conversions. But let me expand on that a little bit. Because we can do Roth conversions out of this bucket, and we can convert as much or as little as we like. But can we do Roth conversions out of this taxable bucket? The answer is no. What if you have $1 million over here? Well, you can look at sending that into a cash value life insurance policy. That acts like a Roth IRA from a tax perspective. There's other requirements around life insurance that you should know about, but that helps you fund money from your taxable bucket, because this will be taxed as either ordinary income, like the tax deferred bucket, or as capital gains. So the most recent recommendation out of the Biden administration for the increase in taxable gains was taking it from the highest at 23.8% to the highest at 44.6%. So folks, 44.6% is much higher than 23.8%. So I've talked about that in the past few weeks. I don't think that tax recommendation or the proposal is going to go through, but that's some of the thinking that's coming out of Washington, so you should be aware of it. So you want to shift as much as you can from this side of your ledger, the taxable and tax deferred, to the tax advantaged. You choose that tax rate, whether it's capital gains rate capital gains rates now are at 0, 15, or 20%. And then depending on your income level, you can add on another 3.8%. But still, even if you're at the total of 23.8%, and even if the last proposal, as I told you, was to increase that to 44.6% for high income earners. But let's say they just increased this to ordinary income tax and it comes in at 37%. Isn't 37% less than 23%? Yes, of course it is. So you're locking in that tax rate for your lifetime plus 10 years in the case of an IRA, and really just your lifetime for your taxable bucket. And it could be longer, right? It could be 10 years or more, because if you first transfer it to a spouse, then that's I'm talking about your IRA. If you first leave your IRA to your spouse can continue that as their own IRA, and then they can pass it to their heirs. And then currently under the current tax code, that 10-year rule could apply. So it's simple, right? Convert to a Roth IRA, potentially fund cash value life insurance, but it's not easy. You, of course, have to develop a financial plan around this. You have to review that plan every year. You have to be very, very detailed in your financial plan. It can't be a simple kind of one-page financial plan. It's got to be an in-depth financial plan. It considers your expenses, your tax situation, your assets, your income, all those things. There are many considerations, not just tax. Of course, tax is one of the considerations. How much tax can you pay, or how much tax do you want to pay in any given year when you do these things, these conversions, these liquidations? You got to consider the tax. You got to consider other things that are triggered by these things, like IRMA, increased Medicare costs by the income-related monthly adjustment amounts. I did a whole video about IRMA. So here we go. I'm going to write that down. IRMA. You've got to look at the effect of tax credits, because you might be counting on a tax credit like an EV credit or something like that. And then if you do a Roth conversion because your modified adjusted gross income is too high, then that tax credit goes away. You have to be concerned about cash flow. Can you afford these things? I want to pay the tax either out of my withholding or out of my taxable bucket, how is that going to affect my cash flow for the things I want to do either now while I'm working or in retirement? And there are other considerations to take into account. Your charitable inclinations, your gifting inclinations, your estate transfer. There are a lot of things to consider. So it is simple. We're converting from the tax deferred bucket to the tax advantage bucket, Roth IRA. We're transferring money from your taxable bucket to a cash value life insurance policy. Very simple concept, not simple application. Simple but not easy. Timing. I was speaking to somebody yesterday, and they said, well, I've got time. I've got time to consider this, and I want to do some Roth conversions. I want to do whatnot. I said, that's great. Don't let another tax door close, because this person in particular had been planning on Roth conversions for the last several years. I think 3 or 4 years have gone by, and they haven't acted because there's a lot to consider. So it's not a criticism. It's a lot. It can be overwhelming. You could do too much. You could do too little. But don't let another tax year close. What do I mean by that? If we go back to this, you think of it this way. So between 2024 and the needed tax change here at 2030, we've got a few tax years left. Once that tax year closes, once the 2024 tax year closes, 1231 comes and goes. For this year, you can no longer do a Roth conversion. You can't do it for 2024. That's done. That door's closed. Then once 2025 closes, that door's closed. You can't retroactively do it. You can do a contribution retroactively up to the tax filing deadline, but you cannot do a conversion retroactively, which you could, but you can't. So once these doors close, you're done. We get to the point where those tax law changes have happened. You've got higher tax rates. Gas is not as cheap as it used to be. You can't buy it anymore at $1.85 a gallon. You're going to look back. You're going to be at a much higher tax rate, and you're going to say, geez, I wish I would have acted then. I've never had a person sit at our table or across from the webcam and say to me, I wish I would have waited another 5 years to do this. It's always the other way around. It's always, geez, I wish I would have done this 10 years ago. I wish I would have done this 5 years ago. So don't wait. Don't wait. Take the steps to act now. And that is how you choose your retirement tax rate. You can do it. It is simple. It is not easy. It is actually quite complex, but you can do it. Don't look back and say, I wish I would have. Take steps today. If you need help with that, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if it makes sense for us to schedule a 15-minute phone call, you and I will have a 15-minute phone call. We can work through what your ideas, issues, progress may look like. I'm happy to do that. If you want more information or want to look at past videos, well, you can certainly find past videos on our YouTube channel. I would appreciate if you subscribe, like, and hit the notification buttons on our YouTube channel. Feel free to browse. We've got over 200 videos now. We've been doing this for more than 4 years. We've been doing almost weekly webinars every 4 years to bring, or every week over the last 4 years to bring you this content. You can find out lots of other information on our website at attleborowealth.com. I hope that was helpful for you. I hope it inspired you. I hope I made it a little simpler for you, maybe. Tax code's very complex. These rules are very complex. You have to find a person that you're comfortable with. I talk a lot about our retirement team. And geez, I just said it, so I'm going to include the video. So you've got to put together your retirement team, but don't be afraid of thinking of things differently. Pay attention to these things. We are in the lowest tax rate that we're ever going to be in. If you're a married couple, you've got more risk than a single filer because you're going to have that drop. You have greater opportunity as a married couple than you do a single filer because your bands are higher, right? The top of the 24% bracket for you as a married filer is $383,900 compared to $191,950, which means as a married couple, you can shift more money from your tax-deferred bucket to your tax-free bucket or your tax advantage bucket, as the regulators like to call it. So take advantage of these things while you can before the door closes, before, unfortunately, something happens. And if you need help or if you have questions, reach out to us. we're happy to have that conversation. I hope you have a great week. I'm really happy to see you all. I've missed you. And that's it for today. Take care. Bye-bye.